The margin debt in the United States for the month of August is going absolutely parabolic. We are up $75 billion from July to August. So we need to talk about what this specifically means for AMC and really just the overall market in general. But we are at a critical moment in the S&P 500 for the global economy where we could take a sharp turn to the downside or potentially hit all-time highs. So we're going to be going over these two scenarios for AMC and what I do think is likely to happen starting next week. I think there's a good case for a bullish rally as well as a bearish sell-off. So I want to give you guys my honest opinion on this situation. Also, we are just going to be going over the Ortex data and the Stock O tracker data as well, but I do want to take a deep look at these hedge funds and how much their portfolios have increased due to all of this margin debt. So let's get into this video. Tap, tickle, touch, or smash the like button for me. Help push this video out to as many people as possible. And if you get some valuable insight or information out of this video, consider subscribing to the channel. Stick around a while. Let's get straight into it. So first and foremost, when it comes to AMC stock, really why I say that we could either have a bullish rally or a bearish sell-off is due to the fact that we are right on our support and our somewhat resistance level, right? We're at about $40. We've been consolidating for the past couple of weeks with some relatively low volume, going under $40, coming back up above $40, but not really breaking out past $40 too much. We are currently sitting at $40.16. So the fact that we did close above $40 and we actually seen a decent sized little pop in after hours on Friday, up 0.37%. We're likely, in my opinion, to go up with AMC stock. Specifically, what we are going to be talking about when it does come down to the short interest and the margin debt outstanding, but we also could see a sell-off. It would not surprise me to drop down to even, $34, $35 per share. And the reasoning why we could see a sell-off really comes down to the debt ceiling situation and the government shutdown. What you guys need to know, if you hear government shutdown, the stock market is actually performed very well under government shutdowns. During the last 18 government shutdowns, obviously they were very brief, but the overall markets did not move around at all. The average price movement during 18 shutdowns was 0.001%. So it's virtually nothing that happens when the government does shut down. But the debt ceiling, that is potentially going to cause a lot of fear. Just these articles you guys see, the fight over the debt ceiling has the potential to tank the US economy. Here's what it means. And we have all seen these articles. Some analysts are talking about this could instantly send the markets into a 30% bear market. That means the market would go down 30%. So if you were holding high growth, high risk companies, you would go down even more than 30%. So obviously nobody wants to hear that. That would cause a lot of fear in the marketplace. And what you guys need to know is the market revolves around fear. Just like we seen in 2020 when the Roni came out, we seen a huge crash in the overall markets, going down about 35% at the lowest point. About March 20th and March 23rd were those two bottoms. But as soon as people realized it wasn't as bad as they were thinking, that the government was going to step in and basically bail everybody out, help everybody out, the markets instantly rebound. So I think there's a potential here to see a lot of fear in the next coming weeks if something does not happen. As Treasury Secretary Janet Yellen warned that the Treasury will likely run out of ways to pay its bills at some point in October. Friday will be October 1st. So really, by the end of this upcoming week and the next week, that's where you're going to see that peak fear start to kick in if nothing has actually been passed to raise the debt ceiling. And the United States has never once defaulted on its debt. So this could cause a huge level of fear. Obviously, AMC would likely sell off down to a certain extent. And what I mean by that is, we have talked about this many times. If the market does come down, that is what we need for the big shorts of AMC to see their liquidity and their capital really be crunched and to see a restriction of their ability to fund their margin maintenance levels. That's where you're going to see the big shorts come in and actually cover on their short positions. But then again, the United States has never once defaulted. So odds are, I'm about 85% sure the Congress will find some way to either do a stopgap bill or just kick the can down the road a little bit further. So this could just as well be a huge catalyst for the markets to go up, but watch to see the sentiment and watch to see what the big money is doing. The more the market does sell off, that is really telling you where big money is positioning. And that is what I would watch for AMC. If the markets did crash 30% because the debt ceiling was not raised, AMC would probably go down about 50% before you did see a lot of these margin calls coming in and shorts being forced to cover. But let's move away from that topic because we will be able to give you guys plenty of heads up when that is actually happening or before that does actually happen. I just want to give you guys the brief rundown of what that situation is. But let's talk about the margin debt, and this is really all tying in together. Hopefully you guys understand this. And with margin, you compound your gains, but you also compound your losses. So if we've seen a sharp market crash down over 20%, you would see a lot of hedge funds in a lot of pain. Take a look at this. From July, obviously last month, we've seen 844 billion for margin debt, now seeing 911 billion for margin debt. We are well above twice as high as we were during the crash of 2020. So this is getting to be a really bad situation for a lot of hedge funds and institutions, considering all of the bad news that is happening in the economy. The economy is statistically starting to slow down. Firms from all different banks and private companies have put their growth estimates for next year severely behind what they had initially estimated in the beginning of 2021, obviously for next year. So you're going to be looking at a lot of pain for the hedge funds and institutions. But take a look at how over leveraged the biggest shorts are for AMC stock. Just take a look at this. You see from July 20th, July 2020, you guys can see Citadel's portfolio value, Citadel Advisors, has went up over 100%. You have seen this exponential growth. In my opinion, if you have 13,568 positions, you would need an average return on every single position of 100% or a little bit over 100%. So on 13,500 positions, I think it's highly unlikely that you could see these kind of returns. And like I said, with 13,568 positions, give you an average return of over 100%. Sure, it is possible, but very, very improbable without using a lot of margin. Jane Street Group as well. Take a look at this one. This one is incredible. From the start of 2020, going from about 70 billion in assets under management now to 255 billion of assets under management. Then again, with almost 10,000 current positions. So that would be an average return of about 400% on every single position. That is not possible. That is simply not possible in 18 months unless you are severely over leveraged on margin. Take a look at the biggest firm that is short on AMC, at least from what we could tell, the firm that has the most put on AMC. Portfolio value, $711 billion. This is a behemoth fund, but they do have 12,000, about 12,500 positions. And from 2020, you could see they went from about 310 billion of assets under management now to 711 billion of assets under management. Yet again, going up over 100%. And same theory applies to Citadel. It is virtually impossible to get every single position of over 12,000 positions to give you an average return of over 100%. Very, very improbable, right? If not impossible, unless you are compounding your gains with margin, which has been very easy to do throughout all of 2021. So odds are these firms obviously are getting very greedy, so they will be very susceptible to see these margin calls when the market does go down. Now, let's also talk about AMC Entertainment's short interest at 20.15%. We are likely to see this actually explode over the next coming days, just because the fact that we did get the release date for the short interest, that was the 24th of September at 18.99%. Now, Ortex is only an estimate, so we are likely to see the estimated short interest go up to about 22%, in my personal opinion. You're going to see the free flow on loan go up probably to about 25%, and you will likely see the share utilization go up to about 90 to 92%. Those are my estimates. You're looking at about 22% 3% short interest in the next coming days. We'll see if we're right on that. We were right on about the last 5 estimated short interest increases to the upside. Now, we also do have 103.08 million shares that are sold short. And obviously, you're seeing this volume coming down in the stock. So you're seeing the days to cover going up, which is actually a good thing. You're seeing 7 days ago at 1.08 days to cover all of these shares. Now you're seeing 1.28 days to cover. So definitely looking very bullish. We've never looked more bullish with AMC stock. Then again, revolving around what the overall market has in store for us these next coming weeks, that'll make a huge impact on what AMC stock does do. I think AMC is likely to trend with the market for now. If the market does go up a lot, AMC is probably going to go up as well. If the market does come down, AMC is going to come down as well, but it will get to that level probably, if I were to estimate, around $20 per share, maybe $25 per share, where these hedge funds will be crushed. They will, or I should say, we will start to see the smaller hedge funds start to cover, making the price go up, and ultimately really having this double-edged sword effect on the hedge funds and institutions, seeing the stock market going down, their total portfolio values going down as AMC is simultaneously going up. That is the double-edged sword effect. So you essentially have to do something with your short position. Odds are these firms would start to cover just because how risky AMC is. And last but not least, the stock O tracker data, nothing too crazy about. 28,000 calls that are in the money, about 28,000 puts that are in the money, 195,000 calls that are out of the money, and about 100,000 puts that are out of the money. So I think it's likely to pretty much balance itself out. We could see a small gamma squeeze if AMC does go crazy and we really see a big increase in share price, but I wouldn't expect any kind of gamma squeeze really until January 21st, 2022, which, if you think about it, is only about 3 months away. So that is going to conclude this video. If you guys like this information or got any useful insight or my opinions out of this that could help you in any kind of way, hit that like button for me, as well as consider subscribing to the channel. Check out the links linked down below in the description. There's links for free stock as well as the buy and sell alerts, where we do it all over there. We day trade, swing trade, and make long-term investments with stock, options, and crypto. You guys will get access to all of those trades all in real time. We have a very high success rate specific to trading options. So with all that being said, guys, I hope you guys enjoy the rest of your day, and I will see you in the next video.